Dividend Growth Investors, bonjour, Mikey Roux here. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And today we're talking about my latest addition to my portfolio. A company that everybody knows about, a company that might be one of the best purchase of 2023, but not thinking that this stock is going to skyrocket in the second half of the year, but rather in the next 10 years. The new stock I added not too long ago to my portfolio is Home Depot, ticker HD. And then you're going to tell me up front, but Mike, housing starts are going down, we're entering into a recession, interest rates are super high, so why in the world do you like this company? So we're going to address those risks later on in the video, but let's rewind a little back and give you some feedback on what Home Depot is for now and why I love it so much. So Home Depot, that's the world's largest home retail, home renovation store in the world. 2,300 stores across Canada, North America, the US, and in Mexico. So they're just in North America, which could potentially eventually slow them down in their growth profile. But in the meantime, they generated almost $158 billion in sales in 2022. You're gonna tell me, yeah, but that was the good days. What's gonna come up next, right? So what's gonna come up next is resiliency. I expect Home Depot to have a rough time this year. They already announced that they're not going to have like a great year in 23 during their first earnings call, but they decided to focus and bring everything back to their core value. And this is one thing that makes them special is they put the customer and their associates, so their employees, on the front line, at the center of their decision and at the top of their priority. Some people may say, well, Mike, this sounds like a lot of baloney, and everybody will tell you that Walmart came out with their calling their workers associates, and then they don't necessarily treat them right. And I'm pretty sure that you're going to come up with some bad history with Home Depot employees. That happens. But here's one thing that is quite interesting where and the company will tell you something, they will show you those great graphs, and they will talk about the culture, but they will also put a lot of money on the table. They already announced that they would invest a lot in their associates, they would raise their salary, and they actually kind of like disappointed analysts because they said, you know what, our operating margin is going to go down to 14.5%, while the consensus, the expectations were around 15.1%. As you can see on this graph, the company has been increasing their operating margin for a very long time. So what's the link between operating margin going down and the culture of the company? Well, they already said that they are going to invest another $1 billion to raise salaries, to hire employees, and make sure that their associates are happy and they will be performant. The whole picture here is obviously all big companies will make mistakes with their employees. So I'm not telling you that Home Depot is the most amazing company in the world, but when you spend $1 billion in a year and you're willing to decrease your operating margin to make sure that you have a solid associates base that will serve their customers, I think it tells something. And this is pretty much at the center of how Home Depot has been able to build such an amazing business. They have been able to actually beat Lowe's at pretty much everything, and they've grew a lot bigger, while Lowe's has been around for a longer time, and it is a dividend king, while Home Depot is a strong dividend grower, but still a relatively new company compared to Lowe's. So looking at the dividend triangle for the past 5 years, you can see how everything goes up and steady and very smooth. You're gonna tell me, yeah, but they got out by the COVID. That's true, but it has been the case for the past 10 years. They have been able to actually grow faster than the construction business, and we're talking about some solid numbers here. For revenue, it is 9.3% annualized growth rate for the past 5 years, so almost double digit. We have double digit earnings growth rate, so EPS was up 14.65 for the past 5 years. And for the dividend, we're talking about 16.40. So a double-digit growth company for a business that is relatively mature when you think about that. I mean, they're selling like woods, lumbers, they're selling like cabinets and construction tools. But here's the key: they have made those very strong relationship with pro workers. So whenever there's a professional around, they need something on the job, they just go to Home Depot, they get the stuff right away, and then they come back. They benefit, Home Depot benefit from economies of scale. They benefit also from a wide network of stores, and that also helps them to not only serve customers and pro customers, but also on the online business. So they're using their network of stores as a distribution hub, so that makes them a lot more flexible to offer all kinds of products and all kind of service to their customer base. So the three key metrics to follow when it's time to analyze Home Depot are quite simple. The first one is customers transaction. So you want to know how many customer comes in and how much they buy. So the number of transaction and then the average tickets. So the tickets of their bill. I know that whenever I go to Home Depot, my cost is at least $100, regardless of what happened there in the stores. Actually, I go there, I buy a few things, and then I always come back and I have to pay at least $100 of products. So being able to play on how many customer comes in and how many transactions there is, and then increase the tickets. With inflation, it's a little bit easier to increase that part, but the most important part I think is efficiency, and this is the sales per retail square foot. So making sure that each store is being as profitable and as efficient as possible. So there is an entire strategy when you try to improve your store, improve the customer experience. And let's be honest, when you go into a Home Depot, it's not like super fancy with great decoration. It's just about getting the stuff that you need an easy way. So one thing I really like about Home Depot as well is their capital allocation. So first things first, they focus on growth. They spend 2% of their sales in their capital expenditure budget. So improving the stores, opening new ones, making sure that everything is efficient, doing some research on that. So everything towards growth. When you think about that, 2% may sound not that much, right? But when you're selling for more than $150 billion a year, that's more than $3 billion every single year that is being reinvested in those stores to ensure some growth. What's left goes to shareholders. So dividend increase and share buyback program. So both ways to generate more revenue and more total return for those shareholders. Again, it's not just about putting that in their investors fact sheet and their annual statements. It's also about showing that with real money. So I've already told you about the dividend increase, but here's the graph of the outstanding shares over the past 10 years. It has dropped by more than 30%. So when Home Depot says they're doing something with their money, they're actually doing it. So as an investor, I kind of like this part because it will also ensure that earnings per share will increase a little bit faster because you have less outstanding shares, and the dividend is likely going to increase as well because when they're buying back those shares, they can increase their dividend and they have the same total of dividend paid, but I'm getting more money out of it. And last but not least, the more buyback that you do, the more value you can create when you're buying the shares at a lowest price. So obviously, depending on the years, sometimes it's a great deal, sometimes it's not so much, but it will also help to smoother the stock price, not making sure that it doesn't drop like a rock because they're buying back those shares when the price is cheaper. Unfortunately, there are also some risks, and this is why I told you at the beginning of this video that Home Depot needs some patient capital. I don't think it's going to do that well in 23, but I think it is a great timing to start a position because going forward, it's going to be a lot better. In the meantime, our eyes will be focused on debt. Debt is increasing year after year. Obviously, they're focusing a lot on growing the business, on making sure that they're spending that CapEx to ensure future growth, but at one point, they will have to pay down that debt. It's one thing to open new stores and to grow, but it's also another thing to make sure that your balance sheet remains very solid. So far, that's not a problem, but let's be honest, going from like $12, $13 billion to 43 in 10 years, that's a lot of money. And now that interest rates are rising, they might have to tighten their budget a little bit. But the most important risk is definitely the economic cycle that we are in. We know that interest rate has risen, we know that inflation is hurting consumers, and now we're seeing the housing market slowing down. A good way to look at it is to follow the housing starts. It's going to show you how construction business is doing, and obviously with higher interest rates, less people are interested into getting into a new mortgage, so you can see that the housing starts has dropped below 1.5 million for a year. It has been one of the lowest points since 2020, and to have like a good market, we're above a million, but to have a thriving economy, we're around 2 million. So right now we're halfway there. What's going to happen in the next few months? I think the Fed has been pretty adamant that they're going to kill inflation, and if it means that they increase more the rates, well, chances are the housing starts are going to slow down more than that, and it will impact Home Depot sales. They will obviously have a part of it that will be compensated with a lot of consumers thinking, well, I cannot buy another house, but I can surely do some home renovation. So that will probably compensate for a part. But again, it's really about looking forward. We're still in a highly fragmented market. Home Depot is still gaining market shares, and they're still able to grow a lot faster going forward. We just need to go through this recession if we ever end up into one, because still, by definition, we haven't met it yet. Pretty sure it's going to happen this year, but anyway, in the meantime, it's not there. So if you want to have more ideas like Home Depot, I have built a long list of great stocks that I call the Rockstar list. The Rockstar list basically is all the companies that shows a positive dividend triangle. So all companies on the US market and on the Canadian market that shows revenue growth, earnings per share growth, and dividend growth positive over the past 5 years. The idea here is to provide you with a few hundred of stocks that you can download the Excel spreadsheet, play around with more filters, add some metrics, and then select the companies that you love that would fit in your portfolio. But it's a great place to start because you're picking among the best basket of stocks. They're all companies that have shown that they are able to thrive throughout a tough period. And yet today, if you look at a company like Home Depot and you think about their dividend triangle, it's definitely, this is the type of business that I want in my portfolio. So all right, people, let me know about what you think about Lowe's and Home Depot in the comments. Maybe some of you will prefer Lowe's. I used to have Lowe's in my portfolio a long time ago, sold at a nice profit, decided to go back with Home Depot mostly because it grew faster. So let me know in the comment what you think, and don't forget to subscribe to the channel, give me a thumbs up, it helps a lot the channel. And until next video next Thursday, don't forget to stay invested.